No lie, you can knock 2% or more off your mortgage interest rate. If rates are 7, you could get 5. If they go up to 8, you could get 6. This could drop a mortgage payment by $500 a month, save you $140,000 over the life of the loan, or let you buy $70,000 more house for the same money. Rates are really high, and now some economists are saying these high rates could be around for a couple more years, and they could go even higher. If these high rates are keeping you from owning a home, I've got a way out for you. Look at this. 107 Banning Drive is in Pittsboro and is listed at $554,900 with a $30,000 rate buy-down incentive. That means that instead of a 7% interest rate, you'll have a 5.5% mortgage rate. It means you'll pay $28.39 a month instead of $33.27 a month. Here's another one that just went under contract. 829 Avonmore Drive in Wendell was listed at $405,900 with $30,000 in closing costs incentive. That means that instead of paying a 7% rate, you could pay a 4.8% rate. Instead of $24.31 a month, you would only be paying $19.17 a month. Is this a scam? Is it really possible to find these properties? How many of them are out there? These deals are definitely out there, but they can be hard to find. I'm going to show you how to find them, even if you're not in the Raleigh market. And I'm so excited to be able to share these homes with you because not only are rates the highest that they've been in 23 years, but it's been exactly 23 years since I bought my first home. In 1999, mortgage rates were 9%, and we could only get approved for about half the price of a typical home at the time, and we needed a whole house, so we waited. By the year 2000, the world unexpectedly didn't have a technology apocalypse, and rates had dropped to 7%, and so we jumped on it. We thought we were so lucky to have been able to buy a home, but now, especially with prices for homes up and inflation, 7% is not feeling so much like a gift. I know it's easy to fall into the line of thinking that rates are on their way down just because they've been high for a while and we're so used to much lower rates, but we can't make decisions on what we hope is going to happen in the future. Rather, we have to look at what the reality is today. Life happens and no one knows what the future holds. But I just remember those 2 years that Timothy and I sat waiting with rates at 9%, just waiting for the day that we could finally buy a home, paying rent into someone else's bank account. We really wanted our own home, and that rate drop is what allowed us to enter the market. I hope that for some of you, this information is going to be just as life-changing. Maybe this is how you finally get into that house you've always wanted. I want to warn you, though, that there are 2 scenarios in which you should never use this strategy. I'll get to that after I've shown you how it works. This is based on finding the disconnect between the supply and the demand in little pockets around the housing market. Believe it or not, home builders really do want to sell you a house. They have construction loans that they're paying on, and they don't want their houses sitting around while they're making payments on them. So when a builder completes a house on speculation and it hasn't sold yet, they're willing to make a deal to get it off their books as quickly as possible. And the incentives that they're offering on some of these homes is game-changing, but finding them on your own can be hard. You might be thinking, wait, I don't have time for new construction. Doesn't it take 6 or 7 months to build a house? Yes, that's true, but the great news is that these deals are usually on houses that are completed or almost completed. You don't usually have to wait for them. Or maybe you're thinking, I can't afford new construction. Isn't it more expensive than an existing home? Oddly enough, that isn't true. The median price of an existing home in the Raleigh real estate market where I work is $409,000. The median price of a new construction home in the Raleigh real estate market is $415,000. So the prices are higher, but it actually costs less, which I'll show you the math in just a second. If we look at national sales prices, we see that new construction is actually a bit cheaper than existing homes. This is likely due to competition among existing homes and limited availability. But let's look at the math now. The mortgage payment for an existing home at the median price is $27.38. But when you apply these rate incentives, the mortgage payment for the new home at $415,000 is $23.56. But it gets better. That $409,000 house at a normal rate over 30 years is going to cost you a total of $985,000. But that new construction home at $415,000 with the rate incentive over 30 years is going to cost you a total of $848,000. The more expensive home costs you $140,000 less over the life of the mortgage. But let's look at it one more way. Qualification is based on how much you can afford a month. So if you're qualified for the $409,000 existing home at $27.38 a month, that payment is the same as the $482,000 new construction home at a typical incentivized rate. If saving money is less important to you than getting a home big enough for your whole family or finding a home with a much shorter commute, this strategy allows you to afford a more desirable home for a lower monthly payment. So how does it work? Let's go back to the first example. 107 Banning Drive is in Pittsboro. It's a quaint small town outside of Chapel Hill, but also home to Chatham Park, and it enormous live, work, play master plan community. It's listed at $554,000 with a $30,000 rate buy down incentive. Now, we got to talk a little mortgagees to understand how a rate buy down works. You can purchase points that reduce the interest rate. 1 point costs 1% of the mortgage value, not the home price. And I'm assuming a 10% down payment here, so a mortgage value of $500,000. That makes the cost of 1 point $5,000. Now, 1 point will reduce your interest rate by 0.25%. Because the language used is kind of confusing, a lot of people think that paying a point gets you a 1% interest rate reduction, but that's not the case. Again, 1 point will buy down 0.25 percentage point on the interest rate. So when the builder's offering you $30,000 to buy down the rate, that buys you 6 points, which makes the rate 5.5% if you're buying it down from 7%. So the mortgage payment went from $3,327 a month before the rate incentive was applied to $2,839 a month. Here's the breakdown for that second example. 829 Avonmore Drive in Wendell, it was $405,000. The builder's offering $30,000 in closing cost incentives. And here's something to know. Points are just part of closing costs. So if the builder's offering $30,000 in closing costs, you can use that to pay down some points on the interest rate. In this case, 1 point equals $36.54. 30,000 buys 8.2 points, which is incredible, which would be 2.2%. So that would make your interest rate 4.8%, or your payment goes from $24.31 to $19.17. These deals are definitely out there, but like I said before, they're hard to find. This is why. Currently, 41% of new homes in the Triangle are new construction. 5 years ago, it was only 23%. That's a good thing because we definitely have a shortage of housing in the Triangle, especially considering how popular of a relocation spot this has become. We need homes for the people moving here and for the people who currently live here. So we're definitely filling that need with the new construction. The raw number of new construction homes currently on the market is 3,275 homes, but I only found 50 properties that mention special mortgage rates. The reason is that builders learned from the 2008 housing crash how important it is to balance the number of homes you build with the volume of people looking to buy. They build fewer of what's called a spec home these days than they did back in the 2005 to 2008 period. A spec home is a home built on speculation. The idea that when the home is ready to be occupied, there will be a buyer for it. Builders are doing a lot more pre-sales than they did last time around, which is allowing them to keep the ratio of homes available pretty equal to the number of people buying. A pre-sale is when a buyer purchases a home before construction starts. But it's impossible to 100% predict future demand. So builders always have a few more homes than they have buyers for. So the supply is limited, but the rewards can be great if you can scoop up one of these houses. But finding them is difficult. I used to have to rely on the builders to send emails to me about these deals. They aren't all collected in one place until I found a way to do it. The fantastic news is these deals are almost always for homes that are finished or almost finished, and they usually have a required deadline to be under contract in order to get the rate deal. So for these homes, you usually don't have to wait, and they literally come in every price point, in every location in the Triangle, and likely wherever you are too, because it's based on a predetermined guess of supply and demand, which is always a little bit off and happens everywhere and in every price point. There are cheap homes, there are luxury homes, there are homes on acreage, seriously, tons of variety in this list. If you'd like to be added to my new construction incentives email list, there's a link in the comments for you to register. You'll get a monthly email with all of these incredible deals, and if you want some help with your search, I'll put a link down there as well to schedule a call with me to get started. My team would be thrilled to help you if you're in the Raleigh area, or if not, I'd be glad to refer you to an incredible agent in my network around the country who can set up this type of search for you. As great as this is, there are 2 scenarios where you shouldn't use these deals this way. You should only do this if you plan to keep the house for long enough to actually save money. You want your combined monthly savings to be greater than that chunk of money that you use to pay down the rate. Otherwise, you could use that chunk of money for something else. There are online calculators that'll show your break-even month, but generally speaking, the absolute minimum you want to stay in the house is 5 years. I ran the numbers for a few different scenarios for a $300,000 home, a $500,000 home, and a $1 million home, and they all gave me between 59 and 61 months to break even. So 60 months is 5 years. And scenario 2, where you should not take advantage of this hack, is if you don't have some kind of emergency fund set up, you're not ready to buy a house at all, regardless of interest rate. If you can't weather a few months without a job, without losing your home, you're not ready to buy a house. Again, the links for my newsletter and contact information is below, or if you're not ready for that yet, you might like this video.